Hey everybody, James Nutter here from I Am Wealth. Did you know that 3 of every 4 American families say money is their number one household stress? That means 3 of every 4 of your friends say money is their number one household stress. I too have felt it. I imagine you have felt it. Otherwise, you wouldn't be here right now. So that's why we created the I Am Masterclass, a safe space for you to learn with your friends and families how to take control of your money without making critical mistakes. And so thank you so much for being here. And please visit us at iamwealth.com. We offer free financial wellness diagnostics, have a bunch of great resources on there for you. And without further ado, let's jump into the masterclass. Well, thank you all so much for being here. Like I said, it's a Tuesday in July. There's a zillion other places that you could be right now. So we're very grateful that you're here and with us doing it right now. Hopefully you're ready to jump in and learn the 6 key money behaviors of physicians and affluent families that Jeff and myself see that are winning and capitalizing in the world and the economy that we're in right now. A few basic ground rules before we jump in. The chat feature is disabled. Our compliance doesn't allow us to use it. So you will not be able to use the chat feature. So if you do want to come on and share anything, please feel free to raise your hand on the little raise hand, or just unmute yourself and say, hey, I have a question, or turn your video on and raise your hand. I understand some of you are here to just listen and probably don't want to show your face, which is totally understandable. I have been there too. We have 3 commitments. There's no cost for these master classes. There's no sales. We're not going to talk any specific products or anything like that. And because of rule number 1 and number 2, there's no bowl. And I won't finish the rest of that. And just so everybody knows, I Am Wealth is a fiduciary financial firm. And thus, we can't give any individual advice outside of a formal arrangement or a formal financial plan. So for all of you who are registered, we can't talk like specific products or can't give individualistic advice. So we're going to do our best to cover, a high level vision of what we see the 6 key habits are right now. And then for being a preferred, I know most people on this call came from the concierge. So with us being a preferred vendor on the concierge, and for everybody that joins tonight, we'll offer a free strategy session to any one of you that'll be valued at $249, where essentially you can bring your questions to us and we can explain a little bit further about how we do business, maybe perform a little diagnosis of your current financial picture and see if we could be a resource to you. So we will follow up with everybody in a very respectful manner. And of course, you can always unsubscribe or tell us to stop at any point in time. And then also just one disclaimer to put out there, because we're going to talk a little bit about the current state of the economy and what we're seeing and potentials for recession. It's important to note that just because history shows economic cycles like the one we are in and currently facing have led to a recession, that does not guarantee that it'll happen again. It's a statistical likelihood. We're getting a little bit of background noise. If you guys wouldn't mind muting yourselves, that would be awesome. I think I just muted it. Sorry. Thank you. Sorry about that. No problem at all. But anyways, it simply is a statistical likelihood. The purpose of this session today is to provide information. Nothing today discussed today should be taken as a recommendation of financial advice, and all financial decisions should be addressed on a unique basis, like I said earlier, within the context of a fiduciary financial plan. And also, just to put it on your radar, our next masterclass will be August 22nd, and we're deciding between topics right now. One potential will be just on how to entertain your first employment contract as an attending physician when you're last year as a resident or a fellow. Another potential option would just be how to take control of your money and seriously kick butt as your first year of an attending physician. So we'll have more information on that. I know it's transition season right now for residents and fellows. So we want to make sure that you guys are very well informed, or any of your guys' friends on this call or peers or colleagues or whatever it might be. Jeff, anything I missed? Otherwise, I will happily jump into the 6.
No.
Okay.
That was great.
Okay. Awesome. So yeah, Jeff and I are going to go. I'm going to do the first 3. Jeff will do the second 3. We should have some time for Q&A at the end. But like I said, if there's anything that comes up, feel free to raise a hand and we'll try to address it, or at least we'll put it on a shelf for the end of the conversation. So habit number 1 that we see from physicians and affluent families who are winning with their money, both in good times and bad times, is they commit to mastery of the basics, or they commit to a mastery of the mundane. So of course, I'm sure that's not what you wanted to hear. It's not super sexy, but a couple of questions for you guys to think about, and don't feel like you need to answer, but you could raise a hand if you felt that way. But has anyone in the audience ever felt inadequate or unworthy based on their finances? And I would be the first one to raise my hand and say that I've been there many times before. And has anyone ever bought in this Instagram economy, all of us millennials that we're living in right now? My other millennials, of course, I'm sure you felt this too, but has anyone ever bought anything they couldn't afford based on like peer pressure? Like a trip or a drink or a round of golf or whatever? Would anyone mind coming on and sharing? And you don't have to. Jeff can answer the question if you don't. In one word, when you think about money, how does it make you feel right now? Is anyone confident that they want to come on and show? You don't even need to be confident, but you just need to unmute and say, like, in one word, how do you feel about money right now when you think about it? All right, well, we'll ask Jeff. This will be fun because he has a wedding in 10 days. So how do you feel?
Yeah, it's fun. I think pressure is definitely always a thing, making sure that you are providing for people and the people that you care most about. I would say pressure is a big part of it and dealing with that. And yeah, what about you?
I would say at times, like right now, I feel more freedom because of just, we've been able to help some great families this year than I felt in the past. But certainly at times there has been pressure and a lack of security. Let me ask you this, Jeff, when you think about money, how do you want to feel, or anybody else?
Yeah, I have one, but I'll wait. Maybe somebody else has something better.
Go ahead.
I think on the flip side of that, it would just be peaceful, calm.
Yeah. I agree.
Yeah.
I'd say for me, like, freedom is absolutely the biggest thing, to just not have to think about it and not stay up at night thinking about it. And I've certainly been there before.
Sure.
So thank you for sharing, Jeff. How many of you, and this is just a rhetorical question to think through in your head, how many of you know or have heard horror stories? Most people on here will be physicians, not everybody, of attending physicians or maybe just successful individuals, business owners, whomever, especially in America, who live paycheck to paycheck and can't retire, but they make a bunch of money. Anybody ever heard of those people? I certainly have. Definitely, some people in my life as well. So, the point that I'm getting at here is, if you feel inadequate about money, you're not alone. I felt it. Jeff felt it. I'm sure everybody on this call had felt it. And the reason being is just, our education system was not set up for success. I studied finance and accounting in college, double majored. I'm not bragging because none of it was really relevant to real life until I entered the school of hard knocks at age 22 as an entrepreneur. So none of us were taught how to pick goals relevant to us, how to buy a house, how to do taxes, how to build a portfolio in alignment with our goals, how to take no more risk than you need to, how to avoid keeping up with the Joneses, how to protect your downside risk, how to protect yourself from salespeople, how to make wise decisions in real time on the spot, like buying a house, buying a car, planning for college when, things feel pressure and we're in a really competitive housing market like we have been the last few years. So when I get back to mastering the mundane and the basics, they say that mastery takes 10,000 hours. And I'm sure for most of my physician friends on the call, you probably feel like you put in 100,000 hours into your craft so far, working 90-hour weeks in training. So what I want to do is just start with, let's see what mastery of one's craft really looks like. And this comes from someone who, completely dented the universe. When he passed away a few years ago, he was talked about all over the entire world. So Kobe Bryant, sure everybody knows Kobe. I'm sorry if you don't love sports, but it's just a great analogy for this. In his off season, in his training, now, of course, the NBA season is about 6 months, about half the year, 5-6 months. I don't know exactly off the top of my head. But in his off-season training, he had what was called this 6x6x6. So that means for 6 months of the year, 6 days a week, Monday through Saturday, he trained for 6 hours. And in those 6 hours was 2 hours of cardio, 2 hours of basketball skills, and 2 hours of lifting. And he never once missed a day. So I just want to play a quick little video, like 1 minute from Kobe, just about what this looked like. And this is what mastering the mundane is, because that's grueling. And like, imagine doing cardio, even on its own, 2 hours a day for 6 days a week for 6 months. That'd be terrible. So let alone everything else he was doing. So let me play this quick.
Your job is to try to be the best basketball player you can be. To do that, you have to practice, you have to train. You want to train as much as you can, as often as you can. So if you get up at 10 in the morning, train at 11, say train at 12, train for 2 hours, 12 to 2. You have to let your body recover. So you eat, recover, get back out, train, start training at 6, train from 6 to 8. And now go home, you shower, you eat dinner, you go to bed. Those are 2 sessions. And now imagine you wake up at 3, you train at 4 to 6. Right, just relax. Now you're back at it again. 9 to 11. Right, relax, and now it's like you're back at it again. 2 to 4. And now you're back at it again. 7 to 9. Look how much more training I have done by simply starting at 4. Right. So now you do that, and as the years go on, the separation that you have with your competitors and your peers just becomes larger, 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 larger. By year 5 or 6, doesn't matter what kind of work they do in the summer, they're never going to catch up because they're 5 years behind.
So really, the main takeaway in that, and I'm sure everyone on the call can relate, is, I love what he said. When you do that consistently, he didn't just wake up and be Kobe Bryant. He mastered the mundane for years. And he said, when I'm 5 years ahead of you, you can't catch me. So I feel like many of us on this call, whether you're a successful individual, a successful physician, like, what it's like to master a craft and master the mundane. So what does it look like essentially as it relates to money? Like, how do you master the mundane as it relates to money? So I just want to ask a few more questions. Like, are you aware that 3 of every 4 Americans say money is their number one stressor every single year? About 3 of 4. With that being said, about 35% of Americans work with a financial advisor. Are you also aware, I'm sure many of you are, that 42% of physicians year after year through Medscape report that burnout and depression, with money always being a leading cause? And are you also aware that typically 90% of financial advisors fail in their first 3 years? So really what I'm getting at here is, if you want to master the mundane as an individual who is not, a financial expert or financial advisor, if you're starting from scratch, you'd probably have to spend, you can take weekends off, let's call it 90 minutes a day for at least 2 years to get to that place. If you've been a DIY, like a do-it-yourself, or you love doing it, you already feel ahead of the game and you feel confident. Once you get to that 2+ years, it might be 30 days a year, 30 minutes a day for a calendar year. For instance, Jeff, who's on the call, he got his certified financial planner license, which is another level higher than the licenses that I hold as a financial advisor. Took him, it takes roughly 3 years and nights and weekends to get that. I'd say Jeff and myself, Jeff is in his 11th year in the business, or 12th. I'm in my 8th. I'd say it took Jeff and I both 5 years working 40+ hours per week to get to a place where we really felt comfortable helping people and helping ourselves. So really what I'm getting at here is that, the growth and the journey is never ending. You want to master the basics and master the mundane. And, very similar to you as a physician in training, you've seen so many cases, and I'm sure that you've realized is that every single case is unique. And in order to help your patients, you have to treat every patient uniquely and continue to learn and learn and learn. And it's a never-ending growth journey. So the fundamentals remain the same, but the strategies change based on the world around us. And like, Jeff Jeff being in business 10+ years, we see new cases every single month when with a new client or whatever it might be. So you could spend time every day for 20 years or 20 weeks, and then you could take your eyes off the road, just like if you were a surgeon and maybe stop practicing your craft for a little while and try to step back in the OR, and you could immediately, be in trouble. So what specifically does mastering the money mundane look like, and everything you need to know to master the mundane? It really boils down to just understanding fully of where you are today and building offensive and defensive strategies around it. And that basically is just learning about your financial vital signs, is what we call them, and learning how to leverage those. So similar to me, if I was going into the ER with my femurs, sticking out of my leg and blood spraying everywhere, of course they would probably put something on it. But one of the first things that they would do is check my vitals, right, to make sure my heart rate wasn't dropping and I wasn't going to die. So very similar. There's financial vital signs that you should be checking regularly to make sure that there's no urgencies or nothing screaming. And you essentially need to treat your household like a business. So you need to take a financial x-ray. You need to understand your money coming in, your money going out. You need to have all key advisors in your life and their information in one place. You need to have everybody and everything that's important to you and your family all in one place, and all the key people. You need to learn how to leverage and understand all the ins and outs of your employee benefits, learn to manage risks, understand exactly how much money you need to put into what types of funds to hit specific goals, investment decisions, portfolio management, reading and watching economic and market conditions. There's changes in the tax code. There's legislative changes. There's debt statements, income statements, real estate portfolios. So anyways, what I'm getting at is just like medicine or building a business or being successful, you really have to master all of the mundane to fully take control of your money. And that's the first habit of physicians and affluent families winning now, is they've mastered the mundane and they understand all of that, or they work with a team that helps them understand all of it and then learn how they can leverage it. So from here, after you're clear on your vitals, what's next is understanding your values and vision, which I'll talk about in a second, and then figuring out your methods to get from point A to point B, the obstacles you face, and then how you're going to measure your progress. And one quote that I'll share is, if you are willing to do only what's easy, life will be hard. But if you're willing to do what's hard, life will be easy. And of course, none of what I just shared is sexy whatsoever. Like, none of your friends are going to be talking about anything that I just mentioned above in the vital signs at like a cocktail party or anything like that. They'll be talking about crypto or whatever it might be. But that's truly the first key thing, is knowing and understanding your financial vital signs. So some self-assessment questions. Of course, we don't have time to get into all those tonight, which is why we offer the strategy session. But self-assessment questions for you to think about. I blocked off time and the appropriate amount of time in my calendar to master the mundane and stay current with money and my financial plan every week of my life. Step 2 is, at any given time, I understand my financial vital signs and how to leverage them. Step 3 is, I feel certain in my abilities to hit my goals in my present life and future life based on leveraging my financial vital signs. And step 4 is just a question of, how can I improve, or who can help me improve? So that's the first key. Let's jump now into the second key behavior of physicians and affluent families who win with their money in both good times and bad. And they have clarity of what they're doing and the why behind that they're doing it. So they have clearly defined individual and household core values, and they have a clear vision and goals that they review every single day of their life. They have their goals laid out in front of them, and they know the progress that they're making each and every single day. Of course, you can take weekends off, but every single day, just like a business, just like Jeff and I with our business, we review our goals every single day. Every morning we wake up and all our team huddles. So one question to think about is, do you want the coolest, most impressive, sexy story to tell at the cocktail party? Or do you just want the most comfortable, peaceful path to get from point A to point B? Because a lot of people in our society right now are choosing the latter, choosing the former, I'm mixing that up, but the cocktail party essentially, and having the sexiest story. So when you hear rules of thumb, like live like a resident, look in the mirror and ask yourself, does it or did it once bother you a bit that after sacrificing 10 plus years of your life in med school and training, there's now the number one financial advice out there for physicians is telling you, thou shalt conform and live like a resident for the rest of your life. So I'd say step 1 in understanding your why and your vision is just unsubscribing from rules of thumb and keeping up with the Joneses. We all are guilty of it. I've been guilty in our Instagram economy. It's very, very challenging, but it's something that really can cause you to get on the wrong path and chase things that don't matter and aren't in alignment with your values. So a quote from the great philosopher Will Smith says, we spend money that we don't have on things we don't need to impress people who don't care. And all of us are guilty. I've been there before, no doubt about it. So unsubscribe from rules of thumb and keeping up with the Joneses. And there's so much out there on Google and the internet, it causes paralysis. Just like if I Google the weird symptom in my body, it'd tell me I had cancer and don't have much longer to live, and I'd stay up all night. So step 2 in understanding your why and your vision is understanding your values. And a quote from Roy Disney is, it's not hard to make decisions once you know your values. So essentially your values are just your guideposts in life. They're a decision filter. Like my personal core values are impact, growth, and experiences. And if one of you tempted me to start a McDonald's franchise or a fast food franchise, I could easily decline it, even if there was an upside of, let's say, $1 million, because bringing more cheeseburgers to the world doesn't align with my core values. So if you know your values, you can help you make decisions. So with that being said, I'm going to share my screen one more time here and let the great philosopher Will Smith jump in now.
Greatness is not this wonderful, esoteric, elusive, godlike feature that only the special among us will ever taste. You know, it's something that truly exists in all of us. It's very simple. This is what I believe, and I'm willing to die for it.
Yeah.
Period. It's that simple.
I know who I am and I know what I believe.
I know who I am. I know what I believe.
That's all I need to know.
And that's all I need to know. So from there, you do what you need to do.
Yeah.
You know, and I think what happens is we make the situation more complex than it has to
Because
be.
we're looking for complexity. There's got to be something
Absolutely.
complex to understand.
It
Right?
can't be that easy.
No.
So just like Will said, it's clearly understanding what you believe in and knowing that you'll die for it, and not trying to chase all the sexy, shiny objects out there and everything that he said that we all get caught up in. It's really getting back to understanding your values and mastering the mundane simultaneously. And this essentially just starts with asking we'll get you guys like a free guide that I built about discovering your values, but all of your money decisions should be based on your values. It shouldn't be based on your parents. It shouldn't be based on your professors. It shouldn't be based on your friends. It should be based on your individual and your family core values. So, and that starts with asking yourself and key people in your life the right questions. So one question that you could ask is, what is the example I want to be to my friends and family? Who do I look up to and what are their values? If I were to teach a group of high school students 3 values, what would they be? Who are the most successful people in the world and what are their values? And what values would you want someone to share about you at your funeral and your epiphany? That's a deep one. And when you can answer that question, I guarantee you'll wake up tomorrow and live life a little bit more in alignment with your values than you were previously. So step 3 in understanding your why and your vision is just clearly defining your vision and casting it, and do so just using, essentially SMART goals. And I was at a conference recently, and I won't go too in depth just for the sake of time, just to make sure we don't go too far over today, Jeff. But they did an exercise called Life at the New Level. So do me a favor and think in your head, or if you're taking notes, write this down. What is your current monthly income? I'll let all of you take a second just to think about it. You don't need to share. Just think about it in your head, write it down. And right below that, what does your current life look like? What can you afford? What country club, what cars, what boats, what experiences, what kids' college fund, Roth IRA, investments, real estate, hobbies, all of it. Now think about, one could be what you're capable of earning. Don't burn yourself out in the process. If you're gonna go after more money, I'm sure everybody here is making a great amount of money. Or what do you want your life to look like on the new level? Because maybe that Will Smith quote I just shared above hit you a little bit hard about you spending money in places that you shouldn't be spending it. So what will your life look like on the new level if you adjust your life and lifestyle? How much income do you need to live your best life, save for your future goals, send your kids to college, retire on time? Like, what is that? Maybe you already have it. You might already be making enough to hit all your goals. But then what does your life look like on that when you're living your best life? Who do you hang out with? What trips do you go on? What boats do you have? What country clubs do you join? What things do you do? So once you have your basic needs and behaviors met, you essentially need a deeper why and a vision of the best version of yourself to live your meaningful life, because money only motivates people until you have it. And I'm sure everyone on the call has it. So what's your motivation when you already have the money to go to that new level? So clearly casting a vision and making, defining SMART goals, specific, measurable, attainable, realistic, and putting a time frame on all of them. So that's number 2. Number 3 key habit of physicians of affluent family who are winning with their money now is they understand it's not how, but they understand that it's who. So they clearly understand that accountability towards their goal is the necessary fuel to get them to where they want to go faster, and they remain coachable. So surround yourself with other people that are better at you in certain areas of your life that can take you to the next level. Michael, great example. Michael Jordan played 7 seasons without Phil Jackson as his coach. Sorry, I'm using a lot of basketball analogies. I apologize if you're not a sports fan. His regular season percentage was, his record was 251 and 236. He had a 50% winning percentage, and he had a losing record in the playoffs. He was 14 of 23 in the playoffs, or 37%. And he didn't win a single championship ring. The second Phil Jackson joined the Bulls, in 8 seasons, his winning percentage went to 77%, or 455 and 130 in the regular season. And it went to 105 and 37 in the playoffs. And he won 6 championships under Phil Jackson. Funny story, very similar. And actually before that, for all of our local Michiganders on the call, he couldn't get past 80 or the Pistons back when they were winning with Isaiah Thomas and Joe Dumars and all those guys until Phil came in, and then they just ran him over. So similar enough, Kobe Bryant, when he did not have Phil Jackson, very, very similar. His winning percentage in the regular season was 57%, and he had a losing percentage in the playoffs, 42%. And then in 11 seasons where Phil Jackson stepped in as his coach with the Lakers, his winning percentage went about to 68%. And then he was 65% in the playoffs, and he won 5 championships. So I heard this at a conference, that same conference in June that I went to, and I couldn't believe it. I didn't even think about, they were both good players, but they needed to have a Phil Jackson, who's the winningest coach in NBA history, to take them to that next level. So by switching from a mentality, instead of always chasing the how do I get there? What book can I read next? What book can I read next? What can I Google? What ebook, we all have limited time. So instead of spending all that time, figure out who can you add to your life in certain areas of your life that can help you achieve more than you ever could alone. Jeff and I hired a business coach last fall, and we were very tentative about it. It wasn't cheap. And that was our who, and we didn't know it until we did it. And looking back at it now, that was absolutely our who. So stop asking the question how and start looking for the who. And even listing who's to help you tackle, you're all busy, help you tackle time-consuming tasks like cleaning your house or, admin work or whatever it might be, so you can focus more on your family and the joys of your life. So some areas of your life to think about having a different who in. There's a great assessment online. You can Google it. It's called the Wheel of Life. It'll essentially say where you are at different places in your life. I go through it once a quarter, and there's 8 different places. And I always notice I have some glaring vulnerabilities of people and things that I've neglected in my life. So assess, who do you need to find a who in? All the who's, it's like the Grinch or something. Where you need help in life in these different categories of life, with your family, with your relationships and marriage. Maybe it's a marital counselor. There's nothing wrong with therapy. Maybe it's your physical health trainer, nutritionist. Maybe it's your mental health therapist, whatever, meditation, whatever. Could be financial, us here at I Am Wealth or whomever. Your spiritual life, your lifestyle, and then your career and business. So many of us get so one-sided in all those different areas of life that we, miss out and neglect on everything else. So to take it to the next level, physicians in affluent families winning now surround them. They don't try to figure out the how in every area of their life. They find a who that will elevate their life to the next level, just like Phil Jackson did for MJ and Kobe. So for everyone right here, right now, all of you, if you're taking notes, draw a line on your page. If not, just visualize it in your head and just write who. You don't have to do it in all 8 categories at once, but just write down, who is my next who. And I know when I was at that conference, I'm in a stage of life. I know Jeff's getting married. I'm working on that process. So I'm just thinking of, I need to surround myself with people that are in successful marriages, and I need to start picking their brains and start talking to them. So I wrote down a couple people in that area of life. And for business, it was our coach. So anyways, that will be my challenge for you. Who is your next two in one of those areas of life that can help take you to the next level so you can focus more on being the best version of yourself? So with that being said, I think I did pretty okay on time. We will hand the baton over here off to Jeff.
Nice. Yeah, that's a great one. We should probably be trying to, when we're reaching out, looking for those strategy sessions and just encouraging people to chase that down and figure out who their next. I know that'll be one you and I should talk about that next week. Okay, who's the next who? Because that's interesting. I'd love to hear what you were thinking about with finding people in successful successful marriages, just to kind of pick their brain. What that'd be great.
I'll talk to you after you get married, though.
Oh, there you go. Yeah, we'll go
10 days.
One day at a time, right? Yeah, so behavior number 4. What we look at when we see families who win with their money, both in good times and in bad times, one quality that they share is confidence. And it's not something that's just naturally, magically there. It's just in good times, bad times, everywhere in between. They have that kind of steadiness to them. They know what they're doing and why. They're informed. But how do they achieve the confidence in difficult times? Because it's easy when times are good, when the market's booming and everyone's feeling good about their performance and all of that. It's easy to be confident. But when times are tough and we're experiencing volatility, like you look at 2022, what causes somebody to be confident, to remain calmly confident in 2022 is having a plan for times of volatility and executing it. I'm just kind of curious right now if anybody on this Zoom has any stories to share about 2008. Was anybody on this Zoom experiencing any type of concerns or fear as it related to market volatility in 2008? Would anybody have any type of story to share there? Maybe 2008 goes back a little bit too far in the distant past. How about 2020 when the pandemic hit and the stock market took a real sharp sell-off? Anybody experience any concern at that point?
I wonder if everyone's just like out, like exercising, riding their bikes, right? This full podcast time. I'd be doing the same thing. So all good either way.
Well, I know go ahead.
So I know 2008, I was a youngin' then, but I know definitely affected by family with like they bought an investment property down in South Carolina and it ended up, still a little bit of a bummer to, I mean, everything's fine. Everything's great. My parents are great, but definitely something that was hit pretty hard and still affects the family a little bit to this day. I would, share that. I was too young to know a ton what was going on. And I know, Jeff, you were just graduating from Michigan State and trying to find a job or close to it.
Yeah. All the professors in 2008 were hammering us students in class to tell us, I know you guys don't have any money right now, but if you have anything, now's the time to invest. And that's actually kind of one of the primary things we're going to talk about today is how opportune times of volatility can be. But it can be a little bit difficult, right, when the emotional stuff sets in, when you're seeing big digits going south in a quick way. So, but what I would say is that what we saw in clients, as well as people that we know personally in 2020, as just a most recent example, when the market took a real sharp sell-off, that was a great opportunity both for people with looking at moving new cash into high quality growth positions, and then riding that rebound all the way up. Their classic adage of buy low and sell high, instead of the other way around. There was a lot of low buy-in going on at that point in time. Also at that point in time, because of what was going on with the economy as a whole, we saw interest rates going even lower than they had been before that. And we had a lot of people taking advantage of refinancing student loan debt, refinancing mortgages. Lots of cool things can occur on the heels of a stock market sell-off or a recession or some sort of economic event. So lots of good opportunities follow times of volatility. So the best thing that people can do to achieve confidence is to have a plan, right? So whether it's medical, having a game plan in times we're fearful about our personal health, if we have a roadmap in front of us for how to deal with it, we're going to be more confident. We're going to have more peace of mind. So that's behavior number 4. And I think a great way to demonstrate what that looks like is with a case study. That's going to bring us into behavior number 5, which is don't make costly mistakes. Okay, so one of the worst things that we can do in times of volatility or in times of uncertainty is make those critical errors. And for people, if we, for all of us, whether if it's financial, if it's medical, if whatever it is, if we're facing a difficult challenge and we don't have a trustworthy map to follow, that can make decision making very difficult, and it can cause paralysis. It can cause us to make mistakes, make irrational choices. But let's take a look at this case study. I think this is really fun. We're gonna essentially what we're gonna do is get into a time machine and go back to 1999 and look at 3 families.
This is Jeff's favorite thing to do ever.
So we're going to do a little scenario here, and we're going to look at 3 families since 1999 that they've all been given $1 million. And now it's, what are you going to do with it for the next 23 and a half years? So if we're looking at the do nothing family, they start with their $1 million in January of 1999. Their ending balance as of the end of June of 2023 is $5.64 million. Their average rate of return over that time frame is 7.32%. The panic family began with the same $1 million. Their ending balance was 1.74 million. Their average rate of return was 2.28%. The MVP family, the people that practice planning and having a strategy, start with $1 million. Their ending balance is 6.18 and 7.71 average rate of return over that time frame. So let's just take a closer look at what they actually did differently, because over that time frame, the difference that we're going to demonstrate here is very minimal. So what we're doing here is all 3 families start with $1 million in cash. The do nothing family moves 100% of that $1 million into the Fidelity S&P 500 index. And again, just like we said at the beginning of this session, nothing here is a recommendation. We're not recommending anybody take money and invest it in the S&P 500, but it's just a great way for us to use a benchmark for the, it's kind of the gold standard of the stock market here domestically in the United States. We look at the top 500 companies that trade on Wall Street. S&P 500, if we buy $1 million in that, both the do nothing family as well as the panic family may move $1 million into the S&P 500, 1999. The MVP family moves in 700,000, so 70% of it into that same position, and then they leave 300,000 into the money market fund or a cash equivalent. And again, that's not a recommendation to move into a 70-30 position, but we're just using this as a reference for having a cash reserve that's on the side for a rainy day, for when things get scary, and also for when things get opportune. So what happens over the next 23 and a half years, we have the do nothings. They move their $1 million into the S&P 500. They literally do not make a single change for that entire time frame. And their $1 million grew to 5.64, and all they did was wave a patriotic flag and ride or die with the United States domestic stock market. If we pull that up and just look at that, the do nothings, this is what that image looks like over that time frame. So you can see the red is your portfolio, is the investor portfolio. The blue is the S&P 500. It just hugs it. It's a mirror of that mix. So we're going to see we got some tough years in 2000 and 2002, the dot-com bubble. That was a slow bleed, and that hurt a lot of people. And it'd be really difficult to remain calm for a lot of folks if you don't have a plan, or if you don't have knowledge of context of what's driving what's going on around us. But a lot of people did make some mistakes in there and sell out of those lost positions. But if the do nothing family literally does nothing since 1999, they go through a rough patch, the dot-com bubble. They get hammered in the 2008 crisis, where they're down 37% in 1 year. But over that time frame, they also get hit pretty hard in 2022, last year was the worst year in the stock market that we saw since 2008 for a single year rate of return. But it's really pretty simple, and a lot of people might agree with this on this Zoom, that a lot of it comes down to behavior and discipline. So if you were even to just put this money into the S&P, statistically, that's been a good place to be, right? So it didn't take much. If we look at the do nothings, we'll look at that image first, or sorry, the panic family. This is how their image looks. And we're going to look at the decisions that they made in just a moment, but that's a much different picture that we're looking at here. So if we look back and see what actually happened in that family's decision making, they're doing the opposite of what you're supposed to do. They're selling low and buying high, right? So we only have 3 transactions that occur after that initial investment. They initially moved their million into the S&P 500, 1999. But then in September of 2002, at the bottom of the dot-com bubble, they cut the losses, because who wouldn't have that gut-wrenching feeling seeing 3 years in a row of losses. At a certain point, there were many people who just want to stop the bleeding, right? Can't take any more losses. I'm going to take this cash that I still have while I still have some, and I'm going to wait until things recover. And in July of 2006, post-recovery, okay, things feel a little bit more normal. I'll move back in, move those positions back, all those losses right back into the S&P 500, and then get hit hard again in the 08 crisis. We sell low in the March of 2009, move all of our cash, stop the bleeding again, move back into the money market. And then January of 2012, when things start to look healthy again, we move back in at a high level. And again, similarly in April of 2020, when the market sold off very sharply after the COVID pandemic kind of hit home here in the US, this family, the panic family, cut losses again. So we're seeing a pattern of cutting losses to try to avoid losing everything. And we just see that what happens there with that family is they made 3 sales that cost them millions of dollars. So that's the mistake that we would like to kind of drive home, that we'd want to exercise the #1 rule of investing: buy low, sell high, not the other way around. So let's look at the MVP family. What they do over that time frame is, again, we start with 700 in the S&P, keep 300 in cash. September 1 of 2002, that same era that the panic family pressed the sell button, MVP family's on the other end of that transaction, moving in 100,000 from the money market fund into a growth position and buying low. All they ever do is buy, right? So in March of 2009, at the bottom of the 08 crisis, they move in and buy at historic lows again. And then they buy in at historic lows again in April 1 of 2020, after the COVID sell-off. Let's take a look at what that image looks like. This is where we start seeing that we have a even just side by side with the do nothing family. This becomes more about human behavior and making the right behavioral, taking the right actions at the right times. This has nothing to do with investment selection. It's the exact same group of investments. It's all about when the money is moved in to growth positions. So again, we're seeing that we're picking up over that time frame. If we come back and look at a summary of all of this in one, not just kind of one little easy place, do nothing family did great. And for a lot of people, there's nothing more you need to do, right? We just kind of have to take faith in the financial system, that we use historical data that says if we invest in this way, there's going to be good times, there's going to be bad times, but in general, we're going to see an upward sloping right curve. And so that's one strategy. Panicking and selling losses is another strategy, but we see that it's not working too great. It costs us nearly $4 million to make 3 mistakes. That's a very expensive set of mistakes over that time frame, but we know people who have made those mistakes. And then the 3 MVP family, all they did was make 3 really good decisions, right? Those low entry points, they pick up about 0.5% in average performance over that time frame, and that gives them another $500,000 ending balance. And also to add to that, they started with a 70-30 mix, right? So they started with a more conservative mix and they worked their way up over time. And again, that's just kind of to demonstrate the point that it's not a recommendation for anybody on this call to be in a 70-30 at all times and to always be carrying cash. We're just trying to demonstrate the value of low entry points. And the reason why we're doing that is because statistically, we would foresee that we're heading towards another one of those at some point in the future. This chart that we like to look at here, and I'll jump into this a little bit more down the road. The reason why this matters right now, why people are very interested in it right now, is because we're seeing a trend in the in interest rates that creates an anomaly called an inverted yield curve. And all we need to be looking at here, this is just a chart that shows the spread between the 1-year and the 10-year note government debt here in the US. Every time the blue line tucks underneath the pink line, that's indicating that we have an inverted yield curve. And currently the inversion is more than 2x what it was before 2008, more than 2x the inversion we saw before the dot-com bubble. It's the most inverted we've seen the yield curve since the early 80s, when we had inflation was raging pretty wildly out of control. And we'll touch on that in just a moment of why that's actually occurring. But really what we need to be paying attention to when we look at this page here is simply the fact that what happens after the shape normalizes, when the blue line reemerges over and above the pink line, the stock market sell-off is generally lagging behind that. So it kind of feels like right now where we are in this storm system is essentially kind of like we're kind of in the eye of the hurricane, where we saw big hits coming from the pandemic. I mean, that was kind of like this foreign object that caused a lot of problems for the market, for the economy, for the world economy. Of course, we're still dealing with that. But then also what we're seeing as a result of that first wave of volatility last year, we're seeing a lot of bounce back thus far this year, with all of the indexes are showing a little bit more bounce and recovery. And I think it's kind of lulling a lot of us to sleep, where we think that the worst is behind us. But statistically, and it may be wrong, but statistically, it's highly probable that we're going to see a stock market sell-off has always followed this type of sequence that we're in right now. So really what we're looking at is just behavioral control and having a plan and executing it, which I would say is a great time to just kind of pivot into behavior number 6, which is the 3 MVPs. So we'll take a close look at that for as much as we can, but I'll try to keep it concise because I know we want to hopefully leave some room for Q&A, but I'll jump into that. So those 3 MVPs, because the question would be, okay, so what does that actually look like? How do we build as individuals? How do we build a plan for ourselves that allows us to bring those to be that 3 MVP family? What are the things, what are the tools, what are the data sets that we need to watch so that we can be taking advantage of down markets? So I would say of course, the best thing that anybody on here could do is take a look at our ebook that I'm sure, I mean, maybe it was attached to the invitation to this, but of course we can always send it back out to everybody on the call. But the number 1 MVP, the most vital priority for people who navigate a recession successfully would be to build and maintain a wide moat. And really what that means in our world is having a cash reserve that can supply you and your family with enough reserve. If there's ever an interruption to your income stream, you have enough money to pay. I mean, the rule of thumb out there, I mean, we obviously we loathe the rules of thumb, but a good one to actually apply at all times is to have a good solid 12 months of living expenses in the bank. So if anything ever causes a slowdown of your personal income, your household as a unit, just like a business with money in, money out, if there's an interruption to money into your family household for any reason that's out of all of our control, we still want to make sure that we're all able to keep the lights on, whether it's a business or whether it's a family. So having enough size of what we call a wide moat, surrounding your castle so that you're well protected against outside risks and threats. We like right now to suggest for people, depending of course on people's individual needs and circumstances, maybe now being that we're in that kind of eye of the hurricane and expecting to see good buying opportunities to expand the size of the moat. So maybe going from 12 months of living expenses being in the bank to building your way with extra monthly cash that you could save, expanding your moat size to 24 months. And so the reason why we like to do that right now is, in addition to continuing to dollar cost average into the market, we never want to like dissuade people from doing that. You always want to continue to max out your retirement plans, continue to move money into your positions that you need to based on your individual planning. But we would suggest that it's a great time to systematically begin widening your moat 1 month at a time, so that when we see that storm make contact and knock down some assets that we would like to move into in the stock market, you'll have extra cash there. So you're not just playing defense. You can also be playing offense and going and buying discounted assets. And that's what 3 MVP families do. So expand the moat size, make sure you're well prepared to play defense and offense. Second category there of most vital priority is building a system. So again, it's building a plan and use the right data to support how to watch your plan and work your plan. So the 3 data sets we really like to watch, and we watch for all of our clients, is yield curve shape. We just kind of looked at that just a moment ago, looking at yield curve shape, the behavior of the yield curve, interest rates and inflation, and the volatility index. 2 of those measures that we watch are upstream, and meaning they're leading indicators. So it can kind of help give us somewhat, it's not like a crystal ball, but it gives us context to what's going on downstream when we see volatility, when we see good times, bad times right in front of us that catches the headlines. We like to add context by looking upstream to see how everything's working collectively together. So right now, just again as an example, when we look at the yield curve, I think I have this pulled up. Yeah. So a normally shaped yield curve, if we look at 12 months ago, and it was starting to even flatten out 12 months ago, of course, we were starting to see the Fed raising interest rates to fight off inflation. The blue line is what the yield curve looked like a year ago. It was starting to flatten out, right? There's not much of a difference between the 1 year and the 10 year and the 30 year. It's pretty flat. But right now, the black line is showing the current yield shape curve and the yield curve shape, and the 1 year T-bill is quoting a 5.4% yield, while a 10-year yield is quoting 3.974%. You should never expect to see short-term debt paying a better interest rate than long-term debt. That makes 0 sense. It's an anomaly that's only occurred because the Fed has jacked up interest rates so quickly that the shape of the curve does not have sufficient time to normalize itself. But the reason they're doing that is because inflation had been such a big issue. One of the other things that we look at with that is to look at inflation. And we can see when we look at inflation that Fed Reserve activity has started to work. It's showing signs systematically over the last handful of months that inflation is cooling off, but it had been a big problem, right? So that's why Fed came in and started to raise interest rates to fight that off. But we've seen since November of 2022, inflation has continued to cool down. And that is another domino that's upstream from where we are right now. That eventually, when inflation has shown signs of consistently being normalized, that would be when the Fed will start to bring interest rates back down, if they're not forced to earlier by an early market sell-off, to try to help people out. But these are the numbers that we like to look at that are upstream. But this is showing a similar trend that what we would expect to see, that's going to lead to the yield curve starting to normalize and reemerge back above that pink line. And that would be where we would see downstream that volatility pick up and give us those great buying opportunities, which brings us to the third data set that we love to watch, the volatility index. So if we look at what the volatility index has looked like recently, for those of you who are not fully aware of what the volatility index is, all it is it's an intraday measure that shows how stormy the stock market is, how volatile the market is in any given day. And if we look at the last year, we've seen that the highest it's got, it hasn't even pressed beyond 35. And while that number might not mean anything, let's give it some context and show you what real stormy weather looks like. In 2008, it was up near 80, right? So a pretty significant difference. And even in 2022, when the market was down, we had our worst year in the stock market that we've seen since 2008. We really didn't experience that type of intraday volatility. In 2020, in the pandemic, we saw it press over 60. And of course, we all remember what that was like. But those are the best times to take advantage of those deep lows. We had clients that were moving money into the market, into growth positions on the heels of that sell-off in 2020. And it's a great time to be making good decisions, and it's a terrible time to make bad mistakes. So volatility index, that's a great thing to watch. So those are kind of the data sets that we like to watch as it relates to having a plan. But then we have to, once we have a plan and we have the right data to watch, now it comes down to frequency and executing the plan consistently over time, right? Because it's easy to build it's not easy, but it's somewhat easy to, get some momentum going. But as soon as we build a plan and we're maybe, 10 weeks in or 12 weeks in, or, a whole quarter goes by and we're consistently executing our plan and watching the right things, it's really easy to go off the rails or fall off of our new habits. But we would just suggest that the best thing that you can do is have a kind of an interval sequence built in where you're watching these measures every week. And it doesn't take that long, but we would encourage people to build it in as a part of your routine, that you're looking at those measures on a weekly basis. And then you're also looking for reasons to look closer and more frequently. So the things that you would want to be looking for to be prepared for an opportunity to move money in at some of those historic lows would be, we always want to be looking upstream to kind of give us a little bit of an indicator of what's coming downstream. But when the yield curve normalizes its shape, and I'm sure it surely will, as it always has, that's a time to really be watching much more frequently, because the volatility index could pick up. Statistically speaking, that's when it would be picking up more quickly. But we don't want to take our eyes off the volatility index. We would say that you want to watch all three of those measures once weekly, just to see if there's a reason to look closer. But we always want to watch the volatility index. As soon as it gets north of 40, we would want to be looking at it more than probably every 3 days. If the volatility index picks up beyond 50, you should be watching for opportunities. Doesn't mean you're moving money in right away, but it just means you're watching and you're preparing yourself to take action on a daily basis. So whether you're doing this or you have an advisor doing it, it's really going to be I think this is the most exciting time that we've ever been in since starting to get into this business and helping people make those good decisions at the right times and avoid the mistakes that can sometimes happen. Because we've never been in a storm. It's been since 2008 since we found ourselves with this type of cycle. It's different storm. It's not the same reasons it's been causing the storm, but it's a similar cycle. And cycles like this occur, generally speaking, every 10 to 20 years. And so this is a great opportunity right now to be thinking about how to apply these lessons. So I think the biggest thing that I would just say right now is, check out that 3 MVPs ebook, but I would say more importantly, take some of those key takeaways around what you learned today and how to step forward and try to build a plan that can increase your knowledge, increase your confidence around what you're doing, why, how it matters for you and your family, and definitely take advantage of one of those free strategy sessions that we've offered up for members of the concierge program. And we'd love to be able to see if we can help you figure all this stuff out. That's all I got, James.
That was a beauty, man. That was a beauty. Nice work. So my last challenge, I know we're past 6:30, but thank you all for still being here. It's awesome to have you be here. My challenge for any one of you going forward, of course, you can't just absorb information, or you just can't read a textbook about delivering a baby or, performing open heart surgery or helping out a patient of yours without actually being in residency and seeing it in real time and actually experiencing it, right? So many people get caught up in reading the books, but then they don't apply it to their life. So my challenge to all of you would be to take one of these 6, not all 6, not all at once, just take one of the 6 and ask yourself, which of the 6 is it? And how can I easily apply it in my life in the next 24 hours? Just spend 15 to 30 minutes with yourself in the next 24 hours and just take one action. If it's figuring out who your who is, if you are, if you need to get back in the gym, find a nutritionist find a strength coach or whatever it might be. If you want to take control of your money, schedule a strategy session. If your marriage is, you guys are a little bit arguing and need better communication, go find a marriage counselor. There's no shame in any of it. If it's mastering the mundane, if it's studying the key metrics that Jeff shared, whatever it is, I would just challenge any one of you, even if it's just reading the 3 MVPs ebook and then taking action on it. Just take one of the 6 and take action on it. And then after you do it, take another step the next day, and then another step the next day. And then maybe after you get comfortable with one, you layer in the second one, and then maybe the third. And it could take, I just came back from that conference with hundreds of ideas, and I just implemented 3. And I'm going to put the rest, I'm going to review all my notes like in the fall, and I'm going to come back to them, So that's how I go about it. But would anyone, and no worries if not, you guys have been great for even just being here this long. Would anyone feel comfortable sharing of the 6 they feel like would be the most applicable and the most easily implemented, and the one that stuck out the most? And if you guys got to run, no worries. I know we're 4 minutes over. Well, I'd just say for me, it's just continuing to identify those who's in different categories of my life. I'm trying to find all 8. So Jeff, get married, and then I'll add you to you're already my, friend and, business mentor, but once you get married, I'll add you to that marriage who. But anyways, Jeff, I'll give you a call. Thank you all so much for being here. Jeff, that was awesome. Everybody, I'm pumped. I said that was our best one yet. I feel great about it. Thank you all for being here. We'll follow up with you respectfully. Oh, let's see, John. John hopped on. Thank you, John. Good to see your face.
Yeah, I just want to say, go green, go white. Appreciate the information.
Yeah. There we go. Go green.
Hi, I joined late. I think today has a meeting. Do you guys have a recording?
Yeah, we're recording it right now. So
where I can get the link, the recording, I can review that.
We have to send it to it's a little bit of a process in the financial industry. We have to send it to our compliance team, and then they have to approve it. And if Jeff and I said something wrong, we have to go in and have our video editor edit it. So it could take a month. It could be approved next week. So we'll do our best to get it out to you guys as soon as we can. You should be on our email list, and we'll reach out to you just to make sure, because Corwell seems to block a lot of outside emails pretty well.
Thank
So
you.
you might not even get most of them. So we'll follow up with phone calls and ask if you want us to send it to a different email or whatever it might be. Does that sound good?
Yeah, thank you.
Okay, thank you. Thank you both.
Great question.
Go green, just because it's Jeff's wedding week almost. All right. Thank you guys. Jeff, I'll give you a ring.
Cool.
Thanks, guys.
Thanks,
All
John.
right. Good night, John. Bye. I Am Wealth does not offer individual financial advice outside of a formal consulting agreement. Content discussed in the I Am Masterclass is not and does not represent financial advice, tax advice, and or legal advice. The intent of the I Am Masterclass is to provide extremely valuable financial educational content for free. For personal questions, we hope that you'll visit iamwealth.com and schedule what we call free financial wellness diagnostics to assess the current state of your financial health, and therefore help you and your family take control of their money so they can live a more meaningful life. So we'll see you there. I Am Wealth does not